lot of excitement coming out of Las Vegas for you guys. A lot of great new innovative trading stuff going on here. A lot of trading minds, some of the best and brightest trading minds here. So I'll be giving you updates on social media throughout the day. So keep an eye on that, as well as in Discord. So good morning, Kathy. How are you?
Hi, I'm doing great. I'm looking forward to seeing you in Vegas soon. Still in New
Absolutely.
York, but in a couple hours, like you said, we're flying out to Vegas to do a couple of talks on trading and prop trading in particular.
Excellent. Excellent. I look forward to seeing you and checking out the content. So what do you have for us today? I know it's been we've got some new news in the markets.
Well, I mean, to be quite honest, it's been a relatively quiet morning. I would say, stocks had previously been down. Now they're starting to perk back up into positive territory. This is a week where most of the data we talked on Friday is backloaded. The most significant reports are going to be the first quarter GDP report from the U.S. on Thursday, followed by the PCE deflator on Friday. What's really interesting, Corey, is that in the past couple of weeks, this April in particular, we've seen volatility really compress itself. And this morning, I was doing a webinar with our BK traders, and someone asked a really good question, which is, how can I tell that volatility is low, and this is kind of a difficult environment to be trying to ride those trends, and I should be watching for more opportunities to pick tops and bottoms. And one really good instrument to look at, and some of you may already be familiar with that, is the VIX. We don't have many volatility measures in the market, particularly in the Forex market, but the VIX is a reflection of how the equity market is doing. And since currencies and risk appetite have a very close link with the VIX, I think the VIX, which is right now at very close to its lowest level since January 2022. So the fact that the VIX has been driven so low, I think, is what should tell us that it basically explains to us this kind of consolidative market that we're in. Now, what is the reason for the consolidation, you may ask?
Well, Kathy, let me just ask you a quick question about that. So somebody who's never used the VIX indicator, I'm a big fan of it. Can you give us a quick little primer on it? What am I looking for? What's high? What's low? What's normal?
Great question. I think this is a really good opportunity for me to just share my chart on the VIX. So for those of you, and there's many of you on Twitter Spaces, please click on that YouTube link that I added below the Twitter Space invitation, because we are streaming on the Surge YouTube link as well. And so I just realized that I didn't record my session, but anyway, it doesn't matter. Okay, so let me share my screen. 1 second.
Please, yep.
Share screen. Okay, so right now I have the Aussie up, but I'm just going to put the VIX. So very simple, VIX is the VIX, and then we go to a daily chart, and usually this is best seen as a line chart. Okay, so for those of you, as I said, that are on on Twitter Spaces, let me just drop the link because I can see that it's not showing up. I'm going to drop the link. Actually, you can see the link under the comments. So please join us.
And this is also recorded. It'll be in our recorded section this afternoon as well.
Yeah, I'll post it too. So we're looking at the chart of the VIX, and you're looking at a daily chart. And we have to go to a longer time frame to get a sense of where VIX it has been historically. So if we look at the weekly chart, which is where we're in right now, the VIX is pretty much at 17 right now, which is right around the lowest level that we've had since, we hit this low once in December 2021, but this is pretty much the lowest level since January 2022. So what's considered high? I mean, that was the question you asked me, Corey. Basically, I would say anywhere north of like 23 or so, in the mid to high 20s is, high 20s are obviously very high. When we had the banking crisis, we spiked up to 25, 26. And then prior to that, we've had spikes up in 30s. It's the absolute number is important, but also the magnitude of the spike in the VIX is also very important. So when you have it going from, 18, 19, suddenly up to 26, that the volatility in the market in general as a whole, not just the equity market, including the currency market, has really escalated. So if we look back to the daily chart of the VIX, we've been just hovering around 1650, 17 for a little while since, since the Easter holidays. And it's just been falling and falling and falling and falling. And this is why, volatilities, market movement, volatility trends are pretty much dead at this point. Now, of course, it doesn't always spend a very long time at these low levels. We are currently looking at a weekly chart of the VIX, and you can see even prior time periods where the VIX got compressed, it's usually only about 2 to 3 weeks of time that's compressed. You do have a phase here that it is, but the reason why the VIX is coming down so much is because, first of all, thankfully the bank crisis, panic has eased. So, the VIX has pulled back as a result of that. But the VIX has also pulled back because investors are kind of sitting there waiting to see, what is the next shoe to drop? What is the next catalyst? And everyone, is still kind of guessing about what is the Federal Reserve going to do and say next week. That is really what everything is leading up to, is what is the Federal Reserve going to say and do? I think, there's an 85%, the market's pricing in an 85% chance of a quarter point rate hike for the Fed next week. And so that's not really going to be the market mover. The big question is, are they done? Is that their last hike?
Right.
Or will they do more? And that kind of guidance that they give is what is going to drive the VIX chart higher. And for those of you that are just watching on Twitter Spaces, I'm showing my charts on the YouTube stream. So make sure, click on that so you can watch me talking. You can see my face and you can look at the screen as well.
Well, Kathy, let me ask you this. Pending, the sentiment from the Fed is neutral, how much lower can we expect the VIX to go, and what's the implications of that for a trader?
Well, it depends what neutral is, right? If neutral means that they are raising 25 basis points and they're done, that's actually kind of bad news, right? Because either the market thinks that, well, it's good and bad news. It's good news because it's positive for equities because it means no more rate hikes. It's bad news because, investors will start to wonder, does this mean that there's some things, some problems in the U.S. economy that are more inherent that the rest of us don't know about? Last week when we talked, I shared, and I had this on my Twitter, an image of the probability of recessions around the world. And it was from Bloomberg. And Bloomberg had, a 65% chance of a U.S. recession this year.
Those are high odds.
Yeah, those are. And I think it was like, the UK was like 75 or 80%. So pretty high odds. And those are not the odds that the market, and certainly not the equity market, is discounting right now. So I think if they basically said they're done, or suggested that they're done, it's definitely bad news for the dollar. In terms now, however, probably the most likely chance is that they raise interest rates 25 basis points and drop 0 hints on what comes next, saying that, we're going to
data dependent, right? Yeah. Of course.
Then we're going to watch the data. We're going to watch, financial market conditions. We leave the door open, but we're not sure, all this wishy-washy stuff. Then I actually think VIX could still rise based upon that, because that uncertainty, the market hates uncertainty, and uncertainty is usually reflected in volatility. And so I think that could also drive the VIX higher. I mean, at the end of the day, I think everyone's just kind of waiting for the Fed meeting. Waiting. We're in the quiet period right now, which means we won't be hearing from any U.S. policymakers. And so they're waiting to see, what comes next.
Got it. I know historically there's been some leaks from some New York Times reporters indicating what direction we're going. Have there been any leaks recently that they give us any indication of where the Fed is thinking?
I wouldn't say there have been leaks, but there's certainly been last week comments from U.S. policymakers, which, you can interpret as leaks because they're the ones giving you their interpretation of what they think should happen. And they're leaning towards more dovishness or less hawkishness. And so that is part of the reason why, we've been looking at, equities are pretty much still hovering near their highs. So this is the Dow. It's still hovering near their highs because these policymakers are suggesting that, maybe we're close to being done. Now, this week we have the advanced release of US GDP on Thursday. And we have the PCE deflator, which is the Fed's favorite inflation indicator, on Friday. So those two numbers will help set expectations going into the next FOMC meeting. So I would watch those numbers quite closely. So the front of the week, Monday, Tuesday, Wednesday, we don't have too much going on. Thursday and Friday from the U.S., we have quite a bit going on. So I think we could have a bit of consolidation front of the week and some more action towards the back of the week. And thankfully, I'll be back in the desk the back of the week. I'm going to Vegas only today, tomorrow. I'm back on Wednesday. So I'll be around, covering the markets at the time.
Excellent. Good. I'm excited for your commentary on Friday. We get those numbers early Friday morning, right?
Yeah. I mean, PCE comes up straight at 8:30. And so we get the PCE, Perfect. Personal income, personal spending numbers at the time. And then, later on, we get the pending home sales and the UMich revision. So that's quite a bit on Thursday and Friday.
Excellent. I don't know, are either of these big enough where we are right now in the markets to be a catalyst for us to pick a new direction?
No.
I know we're in quite a consolidative area.
Not really, because GDP, the Vance release, there's 3 releases of GDP for those of you that are not familiar, and the second and third one really don't matter that much. It's really the first one that matters because it's like the first number that we get a sense of where growth was. So that is the one that's usually it will be market moving. It's not going to be a game changer for the Fed at all because GDP is always backwards looking. But it's going to move the markets that day and maybe have some carryover onto Friday. The PCE is more important than the GDP number, but it's actually less watched by most investors. They like the headline growth number. It makes a splashy newspaper headlines. Right. But so it won't be as market moving. But for us as Fed watchers, it's going to be a very, very important input into what we think is going to happen in May.
And can you give us a couple of symbols to look at? What should we be watching to pick a direction on these, maybe for a short-term trade Friday through the weekend?
Well, in terms of what we should be watching, I think that the first movement that we typically see and the clearest movement tends to be in the bond market. And so, I always watch U.S. 10-year yields. I'm going to change this back to my candlestick charts because I actually hate bar charts. But when we look at VIX, it's great for bar charts. But 10-year yields are very, very the bond market is the biggest market, right? And so
that's what Boris says. Everything's based on the bond market.
Yeah, and so that's why if you're going to look for clues on the right interpretation, it should be the bond market. And then that's going to explain or show you what's going to happen in the equity markets and then the currency market and the commodity markets. Gold is also going to be on the move as well. Right now, any novice technician can see lower highs, lower lows in the 10-year yield chart that I'm showing on YouTube. For those of you, you can switch over to the YouTube link that I have on Twitter Spaces. Everyone can see lower highs, lower lows. But, all of this can be easily changed by the data towards the end of the week. But keep an eye on this because right now, U.S. yields are dripping. And the
why? Why are you before you move charts, Kathy? Why are U.S. yields falling?
Well, U.S. yields are falling because, we had a string of weaker data last week. The Philly Fed was horrendous. And I think no one anticipated such a weak number because it was such a good Empire State number. So I think that the sell-off in the bond market is a reflection, or bond yields specifically, because this is bond yields that we're looking at, is a reflection of A, the data, and B, the market thinking or boosting its expectations that the Fed, the next rate hike for the Fed will be their last.
Got it.
And they're pre-positioning for, weak, softer growth numbers, maybe and certainly softer PCE deflator numbers.
Excellent. You clarify that so nicely. Make it so easy to understand. Thank you.
And, now that I'm sharing this chart, I think it'd be a really good opportunity to show you the correlations between the 10-year yield and the dollar. I was trading the euro this morning, Corey, and it was actually quite an easy trade. I was long euro dollar. I start my trading, I tell you, at 6:15 New York time. Just give me 1 second. Let me just fix my chart.
Certainly.
So I'm actually going to go to the euro dollar chart, and then I'm going to add in the 10-year yields because that'll be a little easier. Okay, so there it is. And I'm going to move this to, I'm going to pin this to the left scale. And I'm going to, so what you see here is and I'm going to, make it regular price so you guys can see the correct price. All right. So what you're looking on my charts here is the orange line is the 10-year bond yield. and the candlesticks is euro dollar. So there's an inverse relationship here where, when US yields fall, that's negative for the US dollar, which is positive for the euro. So when I woke up this morning, I came to my trading desk at 6:15. US yields were already down 1.5%, and we can see that on. I'm switching over to the 1 hour chart here, and let me just let me see if I can just. Here we go, the 1 hour chart. So right around 6-ish over here, which is right over here. So we were trading above 110. So we've broken above the key round number, 110. So we were trading above 110. And at the time, US yields were already down a lot. But there wasn't really much movement in euro dollar because everyone was waiting for the rest of the New York traders to join the markets. So I went long euros on the premise that the drop in US yields was going to drive the dollar lower at the New York session. And boom, you see that happening. You see, euro dollar rising just as yields was falling. And to add in, I use ZIP, which is which is our BK Traders indicator. And euro dollar was in the buy zone. Part of the reason why I got into the trade was euro dollar was in the buy zone. And being in the buy zone means that the currency pairs, the background color is green, which means that the longer term trend is positive, and it's trading above the indicator line, which is why it's in the buy zone. So euro dollar was in the buy zone, check mark number 1. US yields were falling, check mark number 2. We're already above the key resistance round number. And also we had German IFO, Eurozone IFO this morning. And the Eurozone IFO, the expectations component was strong. And so investors latched on to that. And the euro was actually one of the best performing currencies this morning. So this was a very, very easy trade. And, this indicator, this analysis, these trades, they're available for, all BK traders, who are members of our service.
As well as SurgeTrader. So anybody who takes an audition gets 30-day free trial to BK Trading. So guys, take a look at that. You can find the details on our website, the BK Trading website, as well as your welcome packet in the email.
Yes, exactly. So if you get a Surge edition, you'll get access to these indicators as well. So it's really great. I use this as trade. The other thing I want to point out is the delayed trade in dollar yen, and this was actually a lot harder. I didn't take this trade, but the yield still gave you a good guidance. I didn't take this trade because dollar yen was in the buy zone. So it told me, Kathy, stand aside. Don't sell dollar yen. But in the back of my mind, I had a strong view that dollar yen was going to drip lower. It took some time, I'll be honest, because if you look here, this is 6 a.m., 7 a.m. New York time, 8 a.m. New York time, 3 hours that dollar yen just rallied. And it wasn't until we got to, I would say, about 10 a.m. New York time that it really kind of recognized this decline in US yields and actually fell. So what I'm going to say is that US yields can either help you get into good trades or keep you out of bad ones. Because if you were watching yields this morning, which were just dripping lower, and you thought, maybe I want to buy dollar yen, it's in the buy zone, it's looking good, it's rallying. If you looked at US yields and the fact that it was lower, should have told you, think again. Maybe you don't want to be in this trade because maybe that's not the right direction of the market. So it's really, really beneficial. And I really love, it's the one thing I really like to look at as a forward-looking indicator of how some of the other things could move.
So one thing we spoke about on Friday was algo trading versus discretionary trading. And this is where discretionary comes in because you saw some confluences that were there, yet it wasn't quite there and you didn't take the trade.
Right, exactly. Because, I also have a strong view that U.S. data this week is probably going to be weaker. I have a strong view that the dollar is bearish after last week's data. I'm looking at yields, they're down. I'm looking at stock futures, they were down this morning. But, my zip kept me out of the trade because I'm in the buy zone, not in the sell zone. So don't trade this, Kathy. Instead, if you want to sell dollars, do it through the euro because you're in the buy zone in the euro. You've got that good data on your side from this morning, the German IFO expectations. So that's how you use all of this information to really pick the best trades.
Right. So even though you had an opinion about which direction things were going, one trade would have worked out much better than another trade. And knowing those and those intricacies of each is going to be very important for you.
Yeah, and that's what we teach you how to do at BK Traders. And that's one of the unique things that we do that, you could have access to as a SurgeTrader and, just learn how we look at the markets.
Excellent.
And for those of you that are in Twitter Spaces, I said that I'm showing my charts on the YouTube stream. So if you want, you can switch over there. A bunch of you still on there. If you want to ask questions, you can ask questions on the YouTube stream. You can ask questions on Twitter. I'll be happy to answer them as we progress.
Hey, Kathy, can we jump over to gold now? I know there's been some changes in gold recently.
I would love to talk about gold, but let's remove all this, spaghetti stuff. Hold on.
Yeah, certainly.
And I want to show you gold. Oh, sorry, ignore this. This is something I'm teaching at the show.
Oh, nice. Don't erase your notes.
But I want to show, hold on, I want to show you what I really want to show you, which is, okay, now we're looking at the gold chart, right? This is a daily chart of gold. And I got a bunch of moving averages here. Yellow's the 20, blue is the 50, red is the 100, green is the 200. And gold closed below the 20 simple moving average for the first time since March, basically. So I think it's 6 weeks ago. This is the first time in 6 weeks that we've had gold close below the 20 SMA. And this is important. I mean, yes, maybe it could be a temporary break, but I think that, this is something that traders should watch very, very closely, because we're dropping below the 20 SMA. We've opened below the 20 SMA. Now, in the grand scheme of things, it's still just kind of 1962,000. But I do think in the near term, we could see this drip lower a bit and head down to 1950, 1960 before, and just in nothing but just mere consolidative trade before we get any real direction going into the Fed meeting. But I wanted to point this out because we have been consolidating around 2000 for some time. And we're finally below the 20 SMA. And it looks like, we could definitely drip a bit lower.
Got it. And Kathy, can you give me the macro perspective here? Why I know you said it's consolidative, but what's going on external of gold? Of course, yields.
Yeah. I think it has to do more with the general risk appetite. Investors are less nervous right now. Equities have been holding, the recent moves. And if the Fed says they're done, maybe equities will rally off of that. I think this just reflects less anxiety and concern in the markets.
So we wouldn't call it risk on. It's just we're not as risk off.
Yeah, that's why I'm not ultra bearish gold, but I do think in the near term we could get a pullback in gold as a result of what the charts are showing. And then also, that the equity markets have been holding on.
Got it.
Perfect. I want to show, a lot of, I don't trade Bitcoin, but a lot of you guys trade Bitcoin. So I want to talk about Bitcoin.
We have a lot of crypto people.
Yeah,
Bitcoin. Please, anything you could give us would be great.
Been in the news. Let me just pull up Bitcoin here on my charts.
Hey, Kathy, share with us, why don't you trade Bitcoin personally?
It's just more distraction. I'll admit that I own Bitcoin and I own cryptocurrencies. It was more as a long-term investment. But it's Bitcoin is just so erratic. I've got too much going on. I personally just don't have the time to trade it. But Bitcoin, first of all, Bitcoin is the best performing asset in Q1, right? That's really due to how terrible it had done before, but it's the best performing asset in Q1. But it's kind of rolled over after the Easter holidays. It's kind of come down a little bit, and since it had such a great first quarter, investors are wondering, should I get back into Bitcoin? And today, for some reason, and maybe it's not coincidence, there's been a lot of reports out about the future of Bitcoin. Like Standard Charter basically projects 100,000 Bitcoin, a Bitcoin worth $100,000. And Bloomberg had an article talking about how Bitcoin could reach 50,000 next year. And there's a lot of, articles on that. And so I wanted to talk about it for that reason. And I think, I find the Bloomberg article the most interesting. I don't know if you caught it, Corey, on the whole halving concept.
Yeah, yes, I have. I've been following it.
So for those of you that haven't, I'm waiting for my chart to load up. If it's not, I'm going to reshare my screen because I really want to show this chart. I'm going to reshare my screen because it's a different thing. I'm going to just do the window. Okay. All right. So now I think I should show this. So Bloomberg put this, and for those of you that are in Twitter Spaces, I'm showing this on the YouTube stream. So head over there. So Bloomberg put together this really interesting chart on the periods of time when we had a Bitcoin halving, which is basically the period when they remove a whole bunch of Bitcoins from the system, pretty much the concept of halving. And, obviously the value increases, but there's oftentimes the value increasing in the lead up to the halving. And the halving is happening in April of 2024. So 1 year from now, which is probably why it's in the headlines today. And you can see when we had the first halving on the left-hand side of the chart, Bitcoin from its low before that period went up 500%. Obviously, it was very, very low value at the time. So, 500% change was not that much. And then the second halving in 2015 led to a 260% increase in Bitcoin. And then the third halving in 2019 led to 178%. So we have to imagine that this one, on a percentage basis, is going to be a smaller increase as well. But I think there's definitely scope for maybe 150% off the lows. The market's already pricing in. But this chart is an older chart, so it doesn't reflect the pullback that we've had recently. So the market is already pricing in it's part of the halving impact, but not the full halving impact. So I find this very, very interesting because I do believe, especially since this chart doesn't reflect the latest pullback, that we could easily see Bitcoin in the 40,000 area. And because a lot of these crypto assets, they love to gravitate towards the really big round numbers. When you're at 45, you might as well go to 50, right?
Right,
it's really funny. I have my latest YouTube video on YouTube/BK Forex is called the $10 billion trade. And it was based upon if you watch the first episode of Secession, the kids were fighting with their dad on the acquisition of a newspaper company. And they were trying to haggle over the price, 8.5 billion, 9.5 billion. They're like, screw it. Let's just go for 10 billion just to really make an imprint. And the dad calls them and says, congratulations, you idiots, for coming up with the biggest number in your head. So that's why 50,000 would be close enough for Bitcoin. If we're in the 45,000, this probably is going to go to 50,000. So 50,000, I think, is very realistic in my opinion, if we're focusing on the halving impact. And I think, there's a very strong, if you have a Bloomberg subscription, you need a subscription to read the article, or you need a subscription to read the article. But basically, they make a very good argument for why, we could see at least another 50%, maybe even more increase in value for Bitcoin going into this halving next year. So I'm an investor. I'm not a trader in crypto. So for me, that's really good information.
Yeah, absolutely. Definitely something to watch.
Yeah.
Now, at these levels as far as investors go, are these still decent levels to get in? Do you anticipate? I know there's been some talks of further pullbacks.
Well, if you look at the chart, there's a couple entry points, right? I mean, it's either right now at the 50 SMA, and I'm going to share my screen again. It's either right now at the 50 SMA or you wait for 25,000. And I think, I just kind of scale in a little bit here, maybe scale in some at 25,000 because we do have that uncertainty with the Fed meeting. I do think it could get down to 25,000 because, obviously a year is a very long time from now. That is more the level that I would love to be a buyer around.
What about a serious risk-off situation? We get bad news from the Fed. Do you anticipate Bitcoin to go down dramatically further in that event?
Well, I don't think it would be, I don't think we would get significantly bad news from the Fed. I think instead it would be significantly bad news in future U.S. data. We talked about this last week where data is delayed. And so we have only begun to see the sorry, I'm just sharing. Some people are telling me the YouTube link has a little issue. So I'm going to share it again.
Totally.
Let me just do it one more time. Okay. So what was I saying? Okay. So data is backwards looking, and we're only beginning to see the contraction in retail sales. And, there's been a lot of warnings for US retailers. And, I've done surveys over Twitter, hundreds of people respond. They're talking about the belt tightening that they're doing, at home. And I think that's indicative of a lot more Americans that took my survey. So I think, we are on track to see more weakness in US data. And if we do get 2 quarters of negative GDP growth, or we do get a couple of more months of negative or weak US retail sales, that's what could lead to more significant risk aversion and the whole worry about recession in the US and other parts of the world.
Right, absolutely. Talking about that, other parts of the world, I know there was an article on CNBC about Europe being the best place to invest in 2023. What are your thoughts on that?
Yeah, I read that article, and I think it's quite interesting. I think that, first of all, Euro is doing very well today. And, when we had the Ukraine crisis, when we had the prior energy crisis, everyone was fearing the contraction that we get in the Eurozone economy as a result of soaring energy prices. Now, of course, none of that ever manifested because the weather was much more temperate. And so this week we have Eurozone first quarter GDP numbers. And that's also one of the most important pieces of data on the calendar. And the Eurozone GDP number is expected to be stronger. And I think, that's indicative of how the economy and the country as a whole, and the region as a whole, is doing, which is that, in general, we're in an environment where, the market had very depressed expectations for Europe, had very depressed expectation for the Euro area and the UK. And everything is starting to surprise to the upside. And as we head into the summer season, they've had a whole resurgence in the travel industry. And I think that between that, as well as the economy improving, and also the Chinese starting to travel, and the ECB having lower interest rates than the US and many other parts of the world, and also being much slower in raising interest rates, I think Europe is, a pretty attractive place to invest. I've been bullish euros for some time. And I think, euro dollar in particular is if we take a look at the euro dollar chart, is in an uptrend that is probably going to just take it higher. I mean, if we look at the monthly chart, we're still, at a relatively low level. We had been up at 124 before. So I think we could easily see euro in the next year.
Investors, what are you looking at as far as investing in the euro? I know you mentioned the euro play here, but what investment grade products are you looking at?
Well, I focus on currencies, and maybe we could chat with Boris about that on indices, but come next week. But I think,
Okay.
In terms of, the investments itself, I think a lot of the sectors that are benefiting from tourism and hospitality will continue to grow. I think those, are probably one of the strongest industries that will benefit from the reopening in China, and Americans still getting a travel bug, in this summer or next summer.
Excellent, thank you. That's great. And just to Kathy, before you leave, would you give us the a roundup of the data this week again that everybody should be looking out for?
Yeah, certainly. So we've got 5 things to watch this week. Number one is, and I'm just kind of going in the order of importance. Number one is going to be the first quarter US GDP report. And as I said earlier, this is the advanced release, which means it's the first one out of the gate. We don't care at all about the we care a little bit about the revisions, but it's far less significant than the advanced release. And the projections basically tell us that the market is looking for GDP growth to slow from 2.6 to 2%. So they're looking for a dollar bearish number. And then number 2, and important, is the PCE deflator on Friday. It doesn't get that much attention from the markets, but it should, because it's the Fed's number one favorite indicator. And it comes alongside the personal income, personal spending numbers. And so that is also expected to be lower, which is another reason why I'm kind of bearish dollars at the onset. And I want to show you this here. As a part of your membership, I also have a heat map illustrating my fundamental biases for the market. And I kind of explain how I'm bearish dollars, what I'm looking at. I'm bullish euros. A reason why I'm bullish euros is because number 3, most important number that we have this week is Eurozone first quarter GDP. And we talked about how, unlike the US, GDP growth is expected to be stronger in the first quarter in the Eurozone. So, I'm going to be watching that number. Then we have the
Kathy, I know we chatted last week about the percentages probability of going into a recession. Even with the higher probability of going into a recession, they're expected to be stronger.
So the higher probability of going into recession is for the UK, not for the Euro area. I'm still bullish UK because I think the market, because while it's a shallow contraction that's expected in the UK, whereas previously it was a deep contraction.
Understood.
So
thank you for clarifying.
No problem. The fourth one is the Bank of Japan rate decision. It's the only rate decision we have this week. This is the very, very first rate decision of the new BOJ governor. So not only is it a determinant of what they want to do right now, but also a signal of what his potential stance is. And what's interesting about this BOJ meeting is that not only will we get it's the first one for the new governor, not only are they going to make a decision on the yield curve control, but they're also going to release their latest economic projections. So they are not expected to change the yield curve. I think that's made quite clear. It's the reason why the yen is lower across the board today against all of the major currencies, because there's been leaks, like you said, about how the BOJ governor and the BOJ is not going to change the yield curve control. But they will release economic projections. And they can't hide behind those projections will change. So they can't hide behind the projections that have nothing going on. And that is where the market is going to interpret what his guidance is going forward. And I do believe it's going to be dovish. And that's why dollar yen is kind of moving away from, the dollar yen is moving differently from euro dollar and pound dollar, and why it took so long for it to move this morning, because overnight, everyone was talking about how how the BOJ was going to do nothing. And the last piece of number for you to watch is the Australian inflation report. Australia has CPI this week. I'm bearish Aussies because CPI, not just in Australia, but across the globe, has been easing. And I think that number is going to reflect itself in the inflation report, and it's going to keep Aussie depressed against all the other major currencies.
Wonderful. Wonderful, Kathy. Thank you so much for your insights. And again, guys, all Surge traders get a 30-day free trial to BK Trading. You'll have all of Kathy's insights here on the heat map, as well as the charts, as well as the indicators, as Boris's as well. So you could reach us on SurgeTrader.com. You could reach Kathy and Boris on BKForex.com or BKTrading.com, as well as all social medias. If you guys have any questions, reach out. We'd love to hear from you. And Kathy, I hope to see you at the show soon, or tomorrow, I should say, and have a great travel.
All right. Thank you so much. Thank you for listening, everyone. We will be back on Friday, 11 a.m. with Boris. So see you all then on